In this video, I will explain what the current ratio is, how it's calculated, what's included in the calculation, what it's used for, and what are some of its limitations. I will also provide an analysis of the ratio in action with a set of sample financial statements. The current ratio is one of the oldest and best known of the financial ratios. It's known as a liquidity ratio because it provides an indication of a company's ability to pay off its current obligations. The calculation is relatively easy. You simply take the current assets and divide them by the current liabilities. In this example, the current ratio is 1.25. There are $25,000 more in current assets than current liabilities, which provides a cushion or safety net to meet the obligations. The main components of the current assets are cash, accounts receivable, and inventory, but they can also include other items such as prepaid expenses. Current liabilities are generally composed of trade payables, government taxes payable such as income tax and payroll taxes, credit card debt, and lines of credit. They can also include the current portion of long-term debt, such as mortgage payments that will need to be paid over the next 12 months. The current ratio is very often used by lenders in not only determining whether a business is a good loan risk, but also as part of the ongoing covenants, which are included in the loan agreement. The reason for this is because the ratio helps to show whether there are sufficient current assets to meet the current liabilities, and how much of a cushion there is to cover off the bank loans. If, for instance, there are $10,000 in current assets, but $30,000 in current liabilities, then it's obvious that the company may have a hard time paying off these debts. The current ratio is calculated to be 0.3 to 1. In this case, the company could be in financial difficulty, and the owners and lenders should be concerned. On the other hand, if there are $20,000 in current assets and $10,000 in current liabilities, then you can see that there are sufficient current assets to pay off existing current liabilities. Once again, the current ratio bears this out at 2 to 1. Banks will often require a ratio somewhere in the range of 1 to 1 to 2 to 1 for lending purposes. From the bank's perspective, the higher the current ratio, the better. A larger cushion provides better security for their loans. However, from a shareholder's point of view, bigger isn't necessarily better. A current ratio of, say, 4 to 1 may be an indication that management has too much of its assets tied up in working capital that could be freed up for other uses. There are a number of limitations to this ratio that have been put forth. There are those who feel that the current ratio is somewhat meaningless. It provides information that is based at a certain point in time, and is therefore a static calculation, whereas the liquidity it is trying to measure is fluid and changes over time. They argue that cash flow and financial statement projections will provide you with a better indication of future liquidity. Perhaps a solution would be to monitor the current ratio monthly in your business and look to see where it's trending. It has also been argued that the rule of thumb of 1 to 1 or 2 to 1 is just that, a rule of thumb. Different industries operate differently and will therefore have different current ratios that are ideal for them. One of the best ways to determine what a normal current ratio would be for your business is to find out what the standard is for your industry and then make a comparison. There are a number of services on the internet that can provide you with this information, ranging from free to several $1,000s per month. The ratio may also provide you with a false sense of security. You need to look at each of the components that make up the ratio. With regard to the current assets, valuation becomes very important. Perhaps an analysis of accounts receivable shows that there are a substantial number of accounts that are over 90 days. This could be an indication of poor collection procedures or account balances that are unlikely to ever be recovered. If that's the case, then perhaps the accounts receivable are overstated. Once any potential bad debts are taken into account and the receivables balance revalued, you'll find that the current ratio has dropped. The same holds true with inventory. Perhaps there is some slow-moving, damaged, or obsolete inventory that is still sitting in the balance. Once these have been revalued to their actual recoverable amount, you'll find that the inventory balance used in the current ratio calculation has also dropped, and therefore so has the current ratio. Someone also suggested that if you want to improve your current ratio, why not build up your inventory levels by reducing sales, or increase your receivables by telling your customers not to pay so quickly, and reduce your payables by paying them off immediately. By doing this, you can improve your current ratio. Common sense would suggest that you would not adopt this approach to managing your business, however, so the current ratio must be looked at very carefully. With all that seems to be going against the current ratio as a tool for evaluating the health of a business, why would anyone want to bother with it? The first reason would be that lenders like it, and if you're going to borrow money from them, they will likely be monitoring it. Therefore, you can't avoid it. Secondly, it is only one piece of a large puzzle, and while it may tell its own story, it's nearly impossible to determine what a puzzle will end up looking like when you only have one piece. However, when it's combined with other financial ratios that provide other measurements, a clearer picture of a company's financial health will emerge. Here are a sample set of financial statements, including the balance sheet and the income statement. An analysis of these statements with regard to the current ratio follows on the next slide. An analysis of these statements indicates that the company has suffered a large drop in sales, which has resulted in large cumulative losses over the prior 2 years. Cash has dropped as a result to help pay down payables. However, given the resulting cash flow crunch from operating losses, the company has been having trouble paying off its payables and government taxes. They've been increasing steadily to the point where they are now over $1 million. The current ratio, which started out at a healthy 1.91 at the end of year 1, has now dropped by more than half to 0.81. All indications are that unless the company can turn things around quickly, it's headed for trouble. Thanks for watching, and I hope you found this video helpful.